This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Myers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone. Scott Myers here with the Self Storage Podcast, recording once again live from the Inside Self Storage World Expo. And we have with us right now, we have Paul Fiorilla with Yardi Matrix. Paul, welcome to the show.
Thank you. Glad to be here.
Well, Paul, if you would, tell us a little bit about your background and your history and how you got into self-storage.
Well, I've been in the commercial real estate market for more than a quarter century now. I got into the industry in 1996, writing for a publication called Commercial Mortgage Alert, which covered the CMBS and the financing of properties. And in 2008, I joined Prudential Real Estate Investors in their research group, where I was responsible for their, outlooks, quarterly outlooks, and white papers and things like that. And then I've been at Yardi now for a little more than 7 years, where I'm director of research and I oversee the research publications. Yardi publishes a wide range of national and metro outlooks in multifamily, self-storage, office, and industrial. And we write white papers and about all those property types, about real estate investment trends and trends in demographics and economic trends that impact real estate. So it's a lot of interesting things happening.
Mm-hmm. Well, my introduction to Yardi came by way of the multifamily community. I was back in multifamily years ago before I got into self-storage. Back then, they were the 800-pound gorilla in a great way. I mean, you guys had the data sources. Any kind of piece of data that we wanted in multifamily, it was there. And so then when I made the shift into self-storage, I was happy to see here at this show that all of a sudden a large booth that Yardi was now coming into self-storage. And so thankful for that. Thankful for the data. Not only, even your free reports that you send out to folks is fantastic, but we've had an opportunity to use the Yardi Matrix, the product itself. It's helped us to make so many great underwriting decisions and just looking at trends and helping us on the investment side. So, speak to us a little bit about, Yardi Matrix and, what an investor, whether it be a developer or somebody looking to buy existing facilities, tell us about that resource and how they can utilize that to make better buying decisions or development decisions.
Yeah, thanks. So, yes, Yardi has been the biggest provider of software and data in the multifamily arena for a while now, and we got into the self-storage sector I guess about 5 years ago, and we have a database of self-storage of 32,000 self-storage properties, which includes 28,000 completed facilities, operating facilities, and about 4,000 properties that are in the development pipeline, including 726 that are under construction right now. So Yardi is, the leading provider of self-storage data, and anybody that's looking to, buy or sell properties or to transact or operate in this arena, our data is valuable to be able to underwrite transactions, to look at market data, demographic, economic data. It's pretty hard to to do transactions, to invest these days, or buy or sell, without having a good understanding of investment trends, property performance, relative from market to market, from property to property, submarket to submarket. And you can get all that from from Matrix. I was at our booth yesterday, and somebody, and I'm from New Jersey, and there was some other investors from New Jersey looking at one of their properties. The property was in Florida, but they were looking at one of their properties. Like, well, how do you get all that information? How do you know all that? So it's kind of funny. It's there's just a tremendous amount of detailed information in Matrix, and then combine that with our software products. Yardi is a very important tool in the self-storage arena.
So one of the conversations that you and I had yesterday was regarding We talk about all the areas that you focus on. There's the demographic data, square footage, index, supply index, market level data. But one of the pieces that I thought was very interesting is really the investment trends that you just mentioned. And so looking into a market and looking at the trending of people that are investing in the market and deals that are transacting, that's a different level that we don't find most places. So, can you speak a little bit about that and how you go about getting that data?
You talked about, you had your webinar, your presentation yesterday talked about some of this, but self-storage is really growing up, and self-storage is trending from being kind of an afterthought, a small niche sector, to being a much larger niche sector that is attracting a lot of institutional capital. Big name, the Blackstones of the world are buying billions of dollars of self-storage. So in 2021, we tracked more than, I think, $12 billion of self-storage transactions, which is more than double the previous record for self-storage transactions. And why is that? Well, first of all, there's a lot of investors that want to put capital into commercial real estate in general, right? So when you look at commercial real estate relative to bonds, other fixed income products or stocks or infrastructure, or whatever else that they have to invest in, commercial real estate looks pretty good right now because it generates regular dividends, and it's got good appreciation, and the fundamentals, which we can talk about later, but the fundamental outlook is pretty good. So that creates the demand for commercial real estate. Now, at the same time, the most sought after major sectors of commercial real estate would be multifamily and industrial right now. They're really flooded with capital. So the number of, if you want to buy multifamily or industrial, you've got a lot of competition. You could have, if you bid on a property, you could be bidding with dozens of other investors, and that's driven down the acquisition yields, the cap rates, whatever you want to call them. That's driven them down to record lows. So that has prompted these institutions to say, hey, let's look at some other things where we got a better chance of winning the bid, where we can get higher yields, and that has been to the benefit of a wide range of the the niche sectors like self-storage, like medical office or data centers. There's a number of those kind of investment sectors that have grown tremendously, and self-storage, because it's performed really well, has been a target of a lot of these investors. Now, when big institutions invest in real estate, they're not looking to buy small facilities because they've got billions and many billions of dollars to invest. They can't invest that 10 million at a time. So they tend to look for big portfolios. And again, you were talking about this in your presentation yesterday. There's a number of billion-dollar plus transactions that we've seen take place over the last year. And that's not just like a one-off thing, because once the sector is now institutionalized, I think that creates kind of a momentum and kind of a change in the market, because now you have a different mentality in the market that I think we're going to see the storage sector grow and develop in coming years.
So I see, the data that we have when we look at as, say, an individual investor or our firm, when we're looking to add a property, that data set that we use to make a buying decision is a little more limited than what you would look at from an investment decision. So when we're putting our projects out there, or we've also started a fund, the investors that are looking to invest capital, into self-storage or into a fund, they're looking at a bigger data set. So they do want to see those investment trends. They do want to see some projections further out, and they don't want to just look at projections of these individual facilities. They want to know where the industry is heading. They want to see demographically, where is everybody moving to? Are they moving to the southeast? Are they moving to Texas? Where are the trends from a geographic standpoint? So those types of data that Yardi is providing is now proven to be more beneficial for us as we continue to go out and raise more capital. And I would imagine, just as you said, some of these funds that have been created that are coming in, they want a wider data set to be able to make these investment decisions.
Right, and when you talk about migration, that's something that we've been tracking for years. I did a paper a few years ago, which illustrated, that parts of the country, the Southeast, the Southwest, have been growing faster. Mm-hmm. Places like Austin, Phoenix, places in Florida, metros in Florida, have growing faster than the nation as a whole for a long time, right? Mm-hmm. That didn't start during the pandemic. Mm-hmm. The pandemic, however, did exacerbate it mm-hmm. in a lot of ways. Mm-hmm. So, for example, the work from home trend, mm-hmm. people can now, people aren't connected directly to their offices anymore. People in some industry, not all, there's some kind of jobs, obviously, where you have to be there in person. There's some jobs where you have to be there part-time, and that's driven more growth from, inner, downtown urban areas to suburbs. Mm-hmm. And then you also have another group of people that have moved to entirely new metros, and the biggest beneficiaries of that migration over the last couple of years has been Florida, Texas, and Arizona. Mm-hmm. So, there was a net outflow of 350,000 people from New York from July 2020 to July 2021. Mm-hmm. And California had an outflow, I forget the exact number, something like 200,000. And the big inflows came from, mostly they came from a lot of the southern states, but, Florida and Texas. And so you have people, that are moving somewhere where, the weather's warmer, the lifestyle is to their choosing, and, they have cheaper prices, although, that's kind of, the prices, mm-hmm. housing in Florida and Texas are going up. But you've had that movement. Mm-hmm. So one of the questions is, how much, one of the we have to try and figure out is, how much that's going to continue. One of the interesting things about, the migration is, on the multifamily side, you look at it, and the gateway markets like New York, Chicago, Bay Area have recovered, despite the fact that people are still not going back mm-hmm. to the office. Mm-hmm. They've recovered a lot of their apartment occupancy. Mm-hmm. So clearly, it's not an either or. Clearly, I think you can make the case that, the Southeast, the Southwest, the Mountain West, those kind of places will continue to grow faster. That doesn't mean, however, that the gateway markets are. There are still plenty of people, I think, primarily, mm-hmm.
Moving younger people in the beginning of their career who want to move there to be around other young people, to have fun that you can have in mm-hmm. the big markets. So, but clearly, and then we look at it on the self-storage data side. The biggest, the fastest growth in rents in the last year and a half, starting in the middle of 2020 through the middle of 2021, self-storage saw record growth, and a lot mm-hmm. of that was driven by the gateway, not the gateway, the Sun Belt, the mm-hmm. secondary markets. Mm-hmm. And we just released our most recent monthly rent update, which you can find by going on our website yardimatrix.com/publications. Mm-hmm. But Miami, Atlanta, Charleston, South Carolina, Tampa, Phoenix, Orlando, Houston, those are the leaders in self-storage rent growth. And the gateway markets, Boston, Philly, New York, San Francisco, San Jose, Washington, mm-hmm. They were near the bottom. Now growth is positive in almost all the markets. So one of the interesting trends is that we look at is, and you hear people talking about it at conferences like this, there's a wide variance in penetration in self-storage between markets, and this is unique to self-storage because mm-hmm. of the way the industry developed. You don't see this in multifamily or office, but mm-hmm. there's a huge variation in the amount of net square feet per person, per mm-hmm. capita, in self-storage. And intuitively you'd think, wow, the markets that are more saturated would have weaker rent growth. But that's not what we're seeing. What we're seeing is, the markets that I just mentioned where we have the fastest growth, most of those are among the most saturated in terms of square foot per person. So, that and in turn, the development pipeline also tends to be fairly robust in those metros as well. So that leads us to conclude that the biggest factors that control rent growth, that govern rent growth, are the demand. So the 4Ds and which I think is primarily the biggest one would be people moving in and out of a market, because people moving one way or another, that creates a need for storage. Death and divorce and other displacement. So the markets, there's very high demand in the markets that are highly penetrated, and that's because those are the markets showing the strongest growth in household formation and movement and migration. So I think that we'll continue to see that. I mean, I think that clearly the pandemic effect will eventually fade, and at some point people will return to their offices. But at the same time, I think it's also very clear that we're going to see a lot more growth in the Southeast, the Southwest, for a very long time. And I think that is, that's a good news, or that's, I think that drives some of the investment decisions in the storage sector.
Well, Paul, I want to thank you for your time, and I know that you've got a lot to do, and getting back to your booth as well. But what's that?
I was going to say, do I have? Can I?
Of course.
2 more minutes.
Absolutely.
So just when we were talking about investment trends, I think it's interesting, and we talked about this yesterday too. Right now, cap rates, acquisition yields are at historical lows, and at the same time, we're in a period of rising interest rates, and so if you are buying properties at 4 or 5%, and now mortgage rates are going up to 4 or 5%, and probably in self-storage in some cases it might even be up to 6%, depending on the property and the borrower. I think we're hitting a very interesting time in our market, where investors have to start thinking about pricing. And we did studies about cap rates and interest rates when I was at Prudential years ago, and the biggest governing factor seemed to be investors' perception of future cash flows. So cap rates were tight when investors, it wasn't necessarily like a one-to-one, there definitely is not a one-to-one correlation with interest rates, but when investors are confident that there's going to be growth in income, they're willing to accept a tighter premium over the risk-free rate. And going back to the financial crisis, that turned out to be a bad decision, because people underwrote cash flow that didn't materialize. Now, in this cycle, we don't see the kind of aggressive lending that we saw in 2007. So generally speaking, we're not seeing like 90, 95% LTV loans, but we are seeing a lot of optimism priced into these deals on cash flow. And, we expect self-storage rents to continue to grow, but not at the rate of 2021, right? So, the 10%, 12% growth was historically high levels. We expect that to moderate in coming years. So I think, it's important that, people in the market that are investing, that they kind of keep that in mind, and make sure that, they're not over leveraged, that they're not pricing in, unreasonably high growth expectations going forward, because we're definitely hitting a period, interest rates are probably going to continue to rise, inflation is high, the Fed's going to keep raising rates. So I think it's a tricky period, and the investors, have to take care with what they're doing going forward. It's just not, like a party. We're just not having like a party going forward, and then that we can, underwrite unlimited growth. So anyway.
Yep. Well, I appreciate that, Paul, and obviously a lot to consider when making an investment decision, and Yardi Matrix is one of those tools that somebody absolutely has to have in their arsenal, in my opinion. So tell us the best way to get in touch with you and or Yardi Matrix to find out more.
Yeah, well, you can go on the yardimatrix.com website. If anybody, is here, we have a booth here today. You can go on Yardi, the research is yardimatrix.com/publications. And we have, you could go read any of the publications, and there's contact information on those. There's contact information on, yardimatrix.com. And, my personal email is paul.fiorilla@yardi.com. So if you can email me there, and I'm happy to, respond.
Perfect. All right. Paul, thanks so much for your time.
All right,
Appreciate
thank
it.
you. It was great.
Enjoy the rest of your show.
All right.
Take care.
You too.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.